Thank you for joining us for our quarterly review. Wow, this is an auspicious beginning, but we'll get through it anyway. I'm Tom
I
Cock. Thank you
thought you were
for,
going to say pretentious beginning.
well, they're pretentious, ostentatious. We can come up with a lot of nickel words. I am the regional director and also co-host of Talking Real Money. Those of you who follow the podcast, thank you for that. Joined today by the inimitable Don McDonald on my left, right, center, whatever it is. He's going to be here. And Derek Jobe, who's our team lead for the advisors in our Bellevue office, which is where we're coming from. By the way, this is the Talking Real Money Bellevue studio for the times I do the podcast here. So it's not the laundry room anymore. It's not some faraway hide. This is actually where it happens. And these beautiful panels deaden the sound because apparently I make too much of it. So today, what are we going to do today? We're going to talk a little bit first about the quarter. Yeah. We're going to spend a little bit of time talking about, what people are saying, even though, we're going to tell you we don't think you should pay much attention to it. We're going to give you an advisor perspective on what all this recent hubbub has meant to our clients, you, and then we want your questions, and Derek will tell you how to do that. But it's pretty easy. You can go to the chat or the Q&A and ask us questions because that's why we're here. We want to answer your questions. And then finally, we will also take a couple minutes to talk about some of the things that we've got coming to you educationally ahead and fun stuff. We have a party here, the Pompeii Wood-Fired Pizza people coming out of retirement, going to do a party for us here in August. So all of that is ahead. But again, this is designed to be answering your questions, so we'll get to those for you. So, okay, so this is supposed to be a review of the first quarter, right? It was not a lot of fun, and very few people saw this coming because we're coming into a new administration, which promised to be, tax cuts and reduce spending by the federal government and growth, right? We're expecting the economy would go a little bit faster because the incoming president is going to be all about that. And instead, we got discussion about why interest rates aren't going down, why tariffs need to be imposed, and mass firings of the federal government, all kinds of things that people did not see coming. So, what did that mean? Well, what that meant was we had a troubled market. We'll talk a little bit more of the specifics here in a minute, but a lot of volatility. In fact, on many people, one commentator called this self-induced vomiting, where we did this to ourselves. But the result was a lot of volatility, frankly, in the first quarter, right, that we saw.
Yeah, I got to tell you though, one person I know did predict it. That would be my wife. Before the inauguration, she said, "I want to go totally to cash. I don't want to be in this market anymore. I'm afraid." So somebody thought something bad was going to happen, and occasionally something bad does happen. And what we saw happen, no matter what your political persuasion might be, what we saw happen was the upending of a system that the market moves very, very little when things happen that are expected. And what we saw were expectations upended by decisions on the part of this administration. It is truly the Trump administration's baby because Congress has been inactive in all of this. It has been all executive orders. And what it has done is confused our trading partners around the world. Now, they knew they were going to get hit with some tariffs. They just didn't know how extreme nor how confusing. And one thing that those tariffs did that I think confused the market more than anything is they upended the faith in our currency too. They really impacted the faith in the United States to be steady in our economic decisions, and that caused the U.S. dollar to fall pretty precipitously. And that can be great for part of trade, and that can be terrible for another part. So it's hard to sell bonds when your currency is weak, but it's easier to sell your stuff when your currency is weak.
Yeah.
What's
So,
funny though is if
oh,
you fell asleep on January 1st and you're in a diversified appropriate portfolio, fell asleep on January 1st, woke up today, checked your portfolio, you would think nothing happened, right? Because you're about even for the year. So despite all the news and craziness, right, we're kind of almost, depending on how you're invested, back to where you started the year. It's really interesting.
Yeah, so let's put the numbers up there. And by the way, while you're doing that, here's the thing that's interesting about exactly that. What do we preach here? Be diversified, have the right balance between stocks and bonds, and don't make moves based on what's happening at the moment, because we know the people that do that just end up with less money. But if you were in the Magnificent Seven, for example, it was a very unpleasant beginning to the year because the Magnificent Seven in aggregate have lost over 20% of their value, including Tesla, which is down about 30%, Nvidia down about 20%, and Apple down 16%. Another reason that we do not use nor recommend individual equities for you, and we don't recommend them on our podcast either. We don't think they're a good idea. There's a lot more volatility. I think it's been a lot of whipsaws this first quarter than you would really have seen that if you hold those very popular Magnificent Seven stocks. Do we have a chance to go to the first slide? Or are you still trying to do that? Our switcher's putting all this together. You know, we have a big crew behind me that's working on this stuff all the time. So if we could just go to the next page, which shows the kind of the numbers, I think are reasonable to look at, and the things you could pay attention to here. Number one, there's only one red arrow, which is good. We want green arrows. But I think what you're
Wait,
seeing.
no, we red arrows are great when you're accumulating.
That's true. For people still putting money in their 401k, you're getting more shares at a lower price or anywhere else. But if you look at down at the bottom, the 20 years, I think 20 years is a reasonable period of time to look at returns. And you can see, for example, the column there marked US stock market has made about 10% a year. That's a pretty much what you'd expect sort of return. But then you start working your way to the right. International stocks have only made 5.2% a year for those 10 years. Interestingly enough, this is the biggest change we've seen in 2025. The S&P 500 is down about 6% year to date, but some parts of the international market, including international value, are up 12 or 13%. So you have this 20% disparity between the international stock markets, parts of it, and then the S&P 500. So this could
Now you're
be
talking about, though, Tom, in the year to date, as opposed to
correct.
these numbers show 1 year, 5-year, 10. You're talking YTD, year to date.
YTD, exactly. So because you're giving the most recent, you're right. But those examples still held. And this is the interesting thing. We have always been believers in holding international securities, be they doing well or not, as we've seen here for 20 years. We know, and I'm going to let you describe this, Don, that there are periods of time where international stocks vastly outperform the U.S. and provide that little bit of ballast when U.S. stocks go into a tailspin, as we saw in many instances in this first quarter, correct?
Absolutely. As a matter of fact, the most famous example of that we seem to have forgotten here less than well, about 20 years later, is that period known as the lost decade. That was the period between 2000 and 2010 when the Standard & Poor's 500, which is a general measure of U.S. stock activity, declined by about 1% per year on average over that 10-year period. Whereas, had you invested in a well-diversified portfolio, you would have posted a positive return if your portfolio consisted of U.S. and international stocks. Now, the amount of that depended on how much you had in international stocks. So, but somewhere around 5 to 7% would have been your average annual return in most typical portfolios that are 50% international down to 30% international. You would have made money during that period in which you would have lost money if you were just a U.S. stock investor.
Yeah, Derek, this has led to these ups and downs, these changes in market conditions really drastically since the first of the year, has led to some work that our folks have been doing as well, correct?
Yeah, absolutely. You know, what's funny about being diversified is you never know when it's going to pay off, right? Don mentioned that 2000 to 2010, it was, it paid huge dividends to be well diversified. 2010 to 2020, U.S. stock market did a lot better. This, 2020 to 2025, U.S. stock market did better, but now here in 2025, the international market's performing significantly better, right? So you never know which economies are going to perform well. So it's important to stay true, even though it's hard sometimes, right? And maintain that diversification year by year.
We promised to talk about interest rates. I looked it up today. The Fed funds rate a year ago was 5.5, by the way. Today it's 4.5. And right now, the people that trade these kind of things are anticipating 2 further cuts this year of about 0.5%. Not as dramatic as some people had thought a few months ago. And you may get less, right? Depending, I think there's an inflation report coming out this week. The impact of the tariffs, which are going to start to be seen here soon. You mentioned, Don, that I think some are as high as 150 or so percent. And the Wall Street Journal, which you have to say is a fairly conservative paper, today said about the White House, if it's worth doing, it's worth doing too much. And so there's a lot of indications that these tariffs will play into the inflation number, and that probably would not be expected to be positive in terms of the Federal Reserve lowering interest rates, would it?
Well, I hate to get into this. I really, truly hate even mentioning the Federal Reserve and the Federal Reserve's adjustment of interest rates, because in the grand scheme of our lives as individual investors, Fed funds rates don't mean a doggone thing. They do not translate into higher bond yields on your income portfolio. They don't translate into lower interest rates on your mortgage or your credit cards. They only impact the rates at which banks borrow from each other overnight, and that does not trickle into the rest of the marketplace. That's why I don't even want to talk about what the Fed will do, because it's totally meaningless. What matters is what you as investors do. It's whether or not you believe you need, not just you, I mean everybody around the world. That's the grandest, most royal you of all. What investors in U.S. Treasuries believe is their likelihood of repaying, and how much risk they're willing to take on. And if they believe the risk, even if the Fed drops rates, if investors around the world believe the risk of owning dollar-denominated U.S. government-backed securities is higher they believe it's higher in the future than it is today, or higher today than it has been, the yield will rise. Interest rates will rise. There's no two ways about it. And inflation almost always causes longer term rates to rise.
So let's go to the next slide. Thank you for that, Don. And so, yeah, again, all these things that have played a role in this first quarter: trade tensions, recession fears. You just mentioned inflation, federal budget cuts, et cetera. Here's the thing. You can look at all this and you can see, if you want, you can pull out some very specific actions that surprised, as you said, Don, the markets. Trump imposes a global steel and aluminum tariffs, which I guess he's rolled back a little bit since then. Then later, the administration seeks deeper cuts to the federal workforce. That was very well publicized. And then stocks really took a big hit when the greater tariffs were announced, some of which have been rolled back. And then, depending on who you believe, there's 200 negotiations that are going on right now. But I think if you pull back and look at this timetable and you squint a little bit, it's really hard to see. It doesn't look very dramatic. It does day by day, right? This is always the case with markets. But when you sort of look at it without a careful eye, it doesn't look like that much has changed, as you said, Derek, since the beginning of the year.
Yeah, what's funny is you look from, December 31st to early April, right? And all of these events that seemed huge at the time happened. Trump sends out one tweet that he's going to pause tariffs for a while, and the market bounces all the way back in about, 45 seconds, right? So I can't imagine, trying to keep up with all of these individual things day to day when, ultimately the market's going to do what it's going to do. And all paying attention to what this stuff does is create more stress, lessen your peace of mind, and probably make it a lot more difficult to enjoy your retirement. I mean, in all honesty, a lot of it's just noise. The market's already priced this stuff in long before.
And as Tom said, he said, squint and look at this chart. Well, I want you to pull up a chart of the U.S. stock market going back 100 years and squint and look at that chart. The line doesn't move sideways. It moves dramatically up at the right end of the chart. If you squint and look at the market and ignore all the bumps along the way, you'll see that it doesn't all of that noise in there, all of that news, if you hadn't listened to it, nothing would have happened.
Yeah, that's a good point. And by the way, I want to remind you again, we are happy to take your questions. In fact, we invite them. You go to the bottom of the page here, right, Derek, and you can go to the Q&A or the chat, either one. We're going to be monitoring that. We want to take your questions. Our plan is to speak for a few more minutes and then get your input on various things that are concerning you, worrying. It doesn't have to be specifically about this quarter. In fact, you know that as your advisor, we advocate that you don't look at this very often, that you don't open up your online statement every day. I know people that do. That leads to bad behavior, because when the market swings by 10%, as it did in a few of those other wilder days earlier this year, that can be troublesome to see how much your account has changed. So we don't recommend that. If you go to the next slide, I think this brings up some other important notes as well, because these are things to think about. Again, we want global diversification. What happened in the first quarter? The U.S. market went down, especially small value, those kind of things. And then the developed and emerging international markets both went up. Unusual, yeah, but they don't always track together. Then also, and we give you more specifics about this over a longer period of time. There's been a lot of discussion, as you may be aware, about whether or not it's just going to be about the U.S. moving forward, because it's done so well, especially since 2012. A lot of discussion about whether smaller companies are worth investing in and whether it makes sense to have any exposure to value. We still believe in all of those things for the reason that you just said, Don. If you go back 100 years, and no, Don and I were not doing this show 100 years ago, for those of you who think we look that old, we weren't. But the reality is those things have worked for a long period of time, and we're always going to want to look at the most evidence we can when building a portfolio, correct?
Well, Tom was very precocious 100 years ago, so he hoped to be doing this, but he was a little young. He was a little bit young 100 years ago. He matured with time. Yeah, no, you've got this. This is so obvious when you look, particularly when you look at this quarter. We have gotten regular arguments from listeners to the podcast. Why should I have international when the U.S. market is doing so well? Well, the reality is that is never is. It always was. It's always past tense. And to write off the economies of the rest of the world, when, think about it for a minute, much of what you are looking at in the room you're sitting in right now is created, was thought up and created in another country. We live in a global economy, no matter how much some might wish to return to the agrarian age of the 18th century. It is what it is.
I'm not a very good farmer, so I don't wish that. But
he is a Luddite.
Well, I mean, on top of that, though, we are adapting somewhat to market times. I remember when I started here about 10 years ago, the U.S. stock market made up about 55% of the global economy. And you can see here today it's 63%. So what we do in our portfolios is always try to somewhat match the makeup of the economy. So our exposure to U.S. stocks has gone up slightly. It's gone from, the mid 50s to the low 60% now that our overall exposure is to U.S. compared to international. So, I mean, you do adapt marginally with the time, right? But no changes that the market doesn't dictate, and no market timing, right? You have to have a consistent, standardized approach.
And one thing we just talked about on the podcast recently, I never know when these things actually air because they get recorded and go out to you some point. And by the way, thank you all for listening. Our numbers are still astounding, amaze me. And please feel free to send a podcast or anyone to the podcast, because we appreciate all of you listening. But one thing this does not reflect, which is a very important number, I believe, over the last 10 years, the US dollar has gained about 20% versus international currencies. That plays a role in all of this. So again, adding those internationals to most people's portfolios, which you do not have them because we all have a home bias, means you're buying those securities which are lower when you consider the value of U.S. securities, and you're going against the grain of what has been a pretty strong run for the U.S. dollar up until this year. So I think those are important things to consider as well.
Yeah. And remember that the averse can be true in the future. The dollar has been strong. The dollar could be dramatically weaker. We don't know. And if the dollar becomes weaker than it is today on the global markets, then that makes those international stocks start to look a lot more attractive. If you don't have them in your portfolio, you need to, but as a client, you do.
Yeah, you definitely do. All right, let's go to the next page here, if you would, sir. And again, we're happy to answer any and all of your questions. Bonds haven't gotten much attention. You mentioned this 10 minutes ago, Don, that interest rates, people have a tendency to equate the Fed funds rate with mortgage rates, which is not accurate because the interest rates are determined really by people using money, as you said, paying money back, et cetera. But there's a lot of numbers. But I mean, there's one that stood out to me, that the 20-year U.S. Ag bond, which has a return of 3%. Now, people are going to say that doesn't sound like a lot of money, which it's not compared to the historical average, which is closer to 5. But remember, bonds, and have done that again here in this quarter. We're looking at fixed income to provide the stability in your portfolio, the reduction of the ups and downs you would get by just being in stocks. Do you have any other takeaways from this particular page of a lot of numbers, Derek?
Yeah, I mean, so bonds are obviously there to be the balance of your portfolio to reduce the volatility, but they're also there to provide income in down markets. So let's say the stock market declines 30% throughout the year, right? The last thing we want to be doing is selling anything that's at a loss and locking in those losses, where bonds usually can at least hold their value or historically go up somewhat during down markets. So that gives us, something we can utilize or sell to provide income to clients who need it. So, bonds aren't overly exciting. The last 5 years, they've been really not exciting because they have struggled the last 5 years overall, but they still play a critical role in your plan.
And I want you to look at a number that's going to speak volumes about how we manage money. A lot of people believe that you should, at times, because they believe that bonds are about income. And to Tom's point, the income is secondary. The primary purpose is to provide stability. And I want you to look at that that top line, the Bloomberg U.S. Government Bond Index long. These are long-term bonds, U.S. bonds going out to 30 years. And I want you to look at the 3 and 5 and even 10-year returns. Those are the kind of numbers you would expect from a portfolio that is partially equities. That kind of a loss in a 3, 5, or 10-year period, or even heavily equities. And that illustrates the high risk. There is a high level of risk when you go out to long maturity bonds, and that risk can be very similar to buying stocks, which is why we don't want you to have much in the way of long-term bonds in your portfolio. As a matter of fact, the only way you should have them in your portfolio is if they're part of an overall bond index. You don't want to overweight ever to long-term.
Yeah, and wow, the 3-year, that's amazing, down 7.7, which takes in that awful 2022, which was one of the worst years in history for fixed income. So nothing, by the way, if that's happened in this quarter, changes our belief about how we're investing. We have not added any substantial new asset, because you're hearing a lot of people adding Bitcoin, et cetera, other things. None of the things that we have believed have changed us at all. So if you go back, I think if you go up one more page, Derek, I think you're trying to skip past all the stuff that we've got coming up for all of you. That our goal here, yes, we enjoy our relationship with you. We love doing the planning. We love doing the portfolio design, rebalance, all that stuff. That is our job, and we enjoy doing it. And by the way, we have a growing staff here in Bellevue. I think this morning at the all-staff meeting, there were 22 or 23 people, a lot of great young people, a lot of great young advisors. We just added another advisor, Luis Salinas, who is amazing. He's already been working with me on stuff. I absolutely love the energy and the enthusiasm. So we have all those people. And if any time when the market makes you unsettled, as maybe it did with some of those big swings recently, you call us. That's our job, is to help hold your hand through all this. Don't be shy about it. That's why these people are here. Some of you have my number and you call me. I'm happy to take those calls too, and I enjoy discussion. So, but here's some of the other things we want to do for you, because we want you to understand not just markets, not just portfolio design. We want you to understand the other things that are going to be important to you as you get older and you get closer to retirement. We have monthly classes now, and so this is company-wide. And company-wide, Apella now manages a little more than $5 billion. We have offices throughout the United States, just added one in Iowa. For those of you who want to drop by Johnstown, Ohio to say hi to our folks there. And we pull on all those resources. So the advisors actually have individual groups made up of advisors from each office. They take a look at various topics and write about them and do presentations. So coming up here in May, we have one on estate planning. These are all, by the way, available at Apella Wealth, and then click on events, all this stuff. And this recording will be up there. By the way, our marketing department does a phenomenal job of taking the stuff that we do and making it available. So you go there and you can sign up now for the May 22nd event, which is going to be discussing estate planning. June 18th is going to be life transitions. And then the guy that we love chatting with him, love getting to know him. For those of you who want to get a swimming lesson in, maybe he's your guy too. Apollo Lupescu will be joining us July 9th to talk about the mid-year review. Of course, Apollo is with Dimensional Funds, a fund family that we've known and used going back for me to the late 1990s. So the classes are there. We also have special editions of the podcast. And I didn't mention the name. Somebody was saying, you got to mention Talking Real Money, for those of you who don't know. And we have a recent one where Don talked to both David Booth, who is the founder of Dimensional Funds, the fund family I just mentioned, and Dave Butler, who's the CEO of Dimensional. That's up there. Also, I strongly advise you to watch the movie Tune Out the Noise, which was made about Dimensional Funds a few years ago. That's available free of charge up at YouTube. Just go there and type in Tune Out the Noise. So those are kind of the online education things we have coming up. Further, for those of you in the greater Seattle area, please mark your calendar for Saturday, August 16th, when we will be doing our annual pizza, dessert, and conversation right here in Bellevue in the parking lot. We're pulling out Pompey out of retirement. They're going to be there doing the thing. People love the thin crust artisan pizza. Don won't be there, so you don't have that threat hanging over your head.
Nope.
So anyway, take advantage of all those things. And if you have any questions about all of them, again, don't be shy about reaching out to us. That's why we're here every day. We love to hear from you, and we want to hear more. Did I leave anything out of there, Derek, on stuff coming up that we're going to offer our clients?
No, I think you mostly covered it. Just make sure, you always take a look at those monthly classes, because there are varying topics actually presented by the advisors. So a lot of good topics. So just make sure you're taking a look and signing up for the ones that you think will be applicable to you or interesting to you.
All right. That concludes the formal part of my presentation. Don, unless you have anything to add, I'm ready to answer questions.
No,
You don't have anything to add? This is
I have nothing to add. I'm saving it all for the podcast later today.
Well, I have a few things that I want to touch on real quick.
Oh, please.
So obviously I work with a lot of clients, and through my conversation with clients over the last several months, I've, really realized that this never-ending stream of negative information from social media, from the news, from your neighbor who thinks he's a stock picker, right, is kind of creating this sense of urgency and this feeling that you need to take some sort of drastic action. So I just wanted to spend a few minutes talking about, what should you or we be doing in times like this? So, the obvious answer is to sit tight, turn off the news, and do absolutely nothing, right? And this is the correct answer in the majority of scenarios, but there are a couple of actions that we do take for our clients on an ongoing basis. So I'm just going to go through those real quick. So the first one is rebalancing. So I think most of us are aware of what rebalancing is, but your portfolio has a target allocation to each holding within your accounts. So for example, we might want 30% in US large cap, 10% in emerging markets, 30% in bonds, so on and so forth. So as the market moves over time, these percentages become skewed, right? As certain holdings perform well and others have periods of underperformance. So if you have 30% of your portfolio in US stocks and 30% in bonds, and US stocks go down 25%, bonds go up 5%, you are now off balance because you're underweighted towards stocks, which have underperformed, and overweighted towards bonds, which have performed better, right? So to get your holdings back on balance, we have to do the kind of, the counterintuitive thing, which is sell the winners and buy the losers, which really goes against human nature. But This is especially true when the stock market experiences volatility because it gives us chances to buy stocks at a huge discount and ride the wave back up. So while market volatility can be unnerving, if you react appropriately, it's actually a pretty good opportunity to come out ahead in the long run. Don, you wanted to add something?
Well, we used to interview Jack Bogle a lot, Tom and I, on various programs. And the punchline of one of Jack's jokes was the following: don't just do something, stand there. And basically, that is so applicable to times like these when markets are moving all over the place and people are screaming, buy, sell, buy, get into alternatives, do something. No, don't just do something. Basically, stand there. And I love the job you did as a living, breathing chart. That was really good.
Yeah, thank you. I've had that conversation a lot recently, as you can imagine. The other thing I wanted to touch on real quick that clients ask a lot about is tax loss harvesting. So this is a little bit more confusing and difficult to explain. So bear with me if you can. So when you sell an investment in a non-retirement account at a loss, you can use those losses in a couple of ways. So the first is you can use it to to offset realized gains. So if you sell something today and it's at a total loss of $5,000, and then you sell something in November at a $5,000 gain, they offset. So you have no tax liability there. You can also deduct up to $3,000 in capital losses against your ordinary income every year, right? So while the market going down isn't fun, there are some, positives to it that can maybe save you some money in the long run. The cool thing about capital losses, though, if there is one, is that you can carry them forward indefinitely. So if you sell something today at a $100,000 loss, which wouldn't be the case, but in theory, and you don't have any gains for the year, you can deduct $3,000 against your income and carry forward that $97,000 loss to the next year. But this part's really important. So when you sell a security at a loss, you cannot repurchase the same security until 30 days have passed. Okay, so this is known as the wash sale rule. So if we sell something at a loss, we then have to buy another fund that isn't substantially similar to hold for 30 days. And then after 30 days, we sell that investment and repurchase the original holding to get you back to your target allocation. Okay, so while tax loss harvesting is great in the right situation, this creates an inherent risk because if you sell a fund to realize $4,000 in losses, you repurchase a different fund for 30 days, and then the market goes up during those 30 days, right? You now either have to sell that new fund at a gain, making all of this pointless or negative, or you have to hold on to that fund in perpetuity because you don't want to realize the gains, right? So you have to ask yourself the question, is, getting this $4,000 loss, which might save you $800 on your taxes, worth altering your allocation maybe forever? I would say no, usually, right? So when you're doing tax loss harvesting, you have to make sure the juice is worth the squeeze, as they say. So I know these times can be scary. There's a lot going on, but just know that, if you react appropriately, you can actually come out ahead in the long run. And we're always keeping an eye on things. So if you have questions ever you feel worried, just call, email your advisor. We're always happy to chat.
Yeah, I think tax loss harvesting is like Roth conversions. It always sounds so easy, just like click the button, but there's more to it than many people realize. So do we have questions, comments?
Yeah, we got some questions. Anything you guys want to add before we dive in?
I'm ready to go.
Yeah, I'm fine. Let's go.
What constitutes emerging market stocks, assuming they're international too, so a combo of us and other?
You want to take that one, Don, or you want me to?
Sure. What comprises an emerging market actually varies slightly, depending on whose measure you're using. For example, and I'm trying to remember which one does which. An emerging market is a market generally that's of a particular size, but there are some curious exceptions to that rule. In one index, and I'm not sure if it's the MSCI or the EFA, South Korea is an emerging market, whereas in the other, it's a developed market. So there is not an exact definition, but generally speaking, emerging markets are those countries that are on track to become first world economies, and the best examples of those, for example, China is still considered an emerging in many cases, and It's the second largest economy in the world, but it's one of the BRIC nations: Brazil, Russia, India, China.
I want to be careful. We do not invest in Russia. So just to make that clear.
Right. But what I'm saying with emerging markets, the definition is it wiggles a
Well,
little.
it's the same as the definition of small versus mid versus large, right? You can't exactly put your finger on an exact dollar amount, but I mean, there's kind of a general.
So you kind of know it when you see it.
Yeah, and by the way, people may forget that in the late 19th century, there was a country in North America. Oh, that's right. It was this country.
Wait,
Was,
no, all countries in the Western Hemisphere were emerging markets back
they were
then.
considered emerging markets. You may or may not get your money back from the bonds. Stocks were all over the place. You had a preponderance of bonds, I think, issued by railroads and canal bakers. Anyway, so it was a place that was, the bet was good, but you had to hang in there for a long time to make it happen.
Another question that kind of piggybacks off of that, should we be investing in China / how much exposure do we have towards Chinese market?
Wow, I don't know the percentage of exposure.
I actually had this conversation recently. So in our 60-40 portfolio, emerging markets make up about 7% of the overall portfolio. And I was looking at a fund semi recently, and China was about 25% of that emerging markets fund. So 25% of roughly 7%, I mean, sub 2%, right? So there is some pretty decent exposure there, right? But it's not anything too huge.
And that is the beauty of diversification. You can be invested in markets that might, for a variety of reasons, seem very frightening today, and yet turn out to be very lucrative in the future. And even a little bit in a portfolio can make you a lot of money if they turn lucrative. But a little bit is not going to, it's very unlikely that the entire Chinese economy would go to zero. But even if it did, your permanent loss would be less than 2% of your portfolio.
I think one of the surprises so far in 2025 has been the performance of emerging markets when you consider the potential impact of tariffs on goods coming out of those countries and what that would mean to them. So far, people are thinking, it might not be as big a deal as being made out to see. So we'll see. It does not change our desire to be globally diversified, to invest in countries that feel risky in some ways. We just want to have some exposure to all those places because you used the word juice earlier, Derek. That's where the juice would be expected to come from over the long haul. Because remember, riskier assets properly invested have provided greater returns over time.
As a matter of fact, that's Brazil is where most of our orange juice now comes from. So we're getting our juice from emerging markets. Literally.
I'm a big buyer of orange juice lately.
Yeah, I believe it.
Yes. Yeah. So any questions? Your own darn fault.
Your own darn fault.
Yeah. No pull. Please fire away in the Q&A. What will happen if the U.S. dollar is no longer the global reserve currency?
Wow.
Oh, I love that question.
That's a good one. You go first.
That's a really good question. We become Great Britain.
Yeah.
Or Europe. What Europe? I mean, we won't fall to the level of, I don't believe we're anywhere near falling to the level of South American economies, but we could. I mean, remember, the British pound was the reserve currency of the planet for a very long time, a couple hundred years, and it is no longer, but it is still a major player globally. And it just means that we get knocked down. It means our bonds are the debt service, the U.S. debt service will increase dramatically if the dollar is no longer the world's reserve currency. We're going to have to pay much higher interest rates to get people to borrow our money.
Exactly. And that's the part that you've heard some discussion about, but not very much. My take always too would be, what currency would we go to if it was not the US dollar? I mean, what country do you trust?
The only one that I could see possibly stepping in would be the euro, period. That's it.
So right now, the US dollar is about 62% of the foreign exchange holdings. I just pulled it up. The euro is like 20 and the rest are inconsequential. So it's still pretty far off. And I think the next natural question is, okay, what do we do to prepare for this in theory, right? Because currency fluctuations help some economies, they hurt other economies. So the answer would obviously be, well, let's own stuff in all the economies, right?
Globally diversified.
Oh, and this is an important point because people oftentimes think I'm invested in Microsoft, so therefore I'm exposed to those economies. Not so fast. Most of the stock market return comes from those specific places, and by properly investing in those companies, those markets overseas, you get the currency diversification that people have a tendency to forget about, which has not been, as I said earlier, positive for a long time. But we could be heading into a period where the US dollar goes down, others go up. We just want to spread it around because we don't know what those next 20 years will look like. Well, Don and I are just hoping for 20 more years, but we don't know what those will be. So,
well, that's why it's important too to be diversified in stocks and bonds and, just have exposure everywhere to help mitigate that risk. Let's see here. How about investing in our neighbors, Canada and Mexico? It's an interesting one.
how about it?
Yeah, you are.
You continue to be. I mean, there's
in the proper percentage.
Right. We discussed this recently on the podcast that despite the rumors, there are great companies in both of those countries. There's reasons to invest in those economies. But we're not overweighting to them for any reason, and we're not changing it based on political situations or tariffs or any of that sort of thing. We're still going to be exposed to those economies, which are obviously very important to ours.
Well, and if there's anything that history teaches us, it's that these political machinations that impact economy short term are temporary. They're constantly in flux. You cannot adjust your portfolio to political conditions because they can change so quickly. The tariff situation was a perfect example. One day we have 150% tariffs, the next day they go away. The market goes way down, the market goes way up. You could not have responded to that. You are not a trader, nor can you be. You don't have the wealth.
Traders hardly even exist anymore. So much of it is automated now, right? You're not standing on the stock exchange with a piece of paper yelling at people. It'd be more fun, but
institutions, more institutional trade numbers will continue to rise. Correct.
This next question is really interesting, and it's a perfect segue off the last one. How can one person / group change the market so quickly? Any future safeguards to avoid this?
So I'm assuming you're talking about recent administration.
Well, yeah, I mean, one thing, a tweet gets sent out. Trump says, and it takes seconds, and the market swings 20% or 15%.
And I think I did comment on this on a podcast recently that in my memory, I don't remember a political leader other than the person running the Federal Reserve who had so much impact on markets so dramatically. But I go back to what you just said, Don, and that is, but most of the time when you look back, that's temporary. Yeah, you look back and think, remember, we're all worked up about that? There's no reason to be worked up about that because at the end of the day, yes, politics plays a role. Yes, tax policies certainly play a role. Tariff policies play a role. All those things play a role. But the bigger participant in the market is these great companies that come along. There was no Meta 20 years ago. Look where Amazon, I just read the Everything store about Amazon, a remarkable story of a company that was right over here in Bellevue in one single garage. These great companies that come along that build the wealth, that's the thing that has really propelled the economy over time and had the greatest impact on markets in my mind. Don?
Well, I'm going to take exception with you because I believe that in every instance, these short-term, politically motivated, politically driven events have ended up being much ado about nothing. I remember back to the 2001 market collapse or whatever it was. I remember back to 87. I was a broker back then. The headlines, the cover of Time magazine showed bread lines. This all gets blown way out of proportion when you have a global economy that is generating $100+ trillion in output. It's really hard to mess that whole thing up with a few policy decisions.
Couldn't have said it better.
Let's see. That it looks like is all the questions that we have. Anything else, gentlemen, want to add?
Should we see what they texted me? I don't know. So
Did someone text you?
they do. They always. Oh, it's personal, so we're off the hook this time.
Okay. Yeah, I think the overall message is actually it's a question to all of you. Aren't you glad you have an advisor right now? I mean, really. Aren't
I mean,
you
it's
glad?
really evident though, because when I've had, I don't know, 100 client meetings this year, and they're all closing their eyes when they pull up returns, because you watch the news and the news talks about 7 companies, 10 companies, right? Which, yeah, they're down 20%, like Tom mentioned, but those 7 companies only make up a minuscule portion of your portfolio when it all comes down to it. So rather than, look at the NASDAQ ticker on the news, actually, if you want to see how you're doing, look at your portfolio, right? Because that's what's actually pertinent.
Or don't even look.
Don't even look, exactly.
So we must be doing okay, because one of our longest clients, who's somebody that is fairly critical of the work that we just wrote, and said you're doing a good job. So thank you for that.
Was
Oh,
that Debbie? Is that Don's wife?
no, you need to call her.
Yeah.
She's still freaking out. Derek's her advisor, so I blame you, Derek.
It's not on you this time.
It's not on me. It's on you. That's why I'm so glad she has an advisor.
Call your advisor if you get nervous or worried. Take advantage of all the educational stuff we have. Make sure your plan fits where you are in your life. Don't worry about the markets day to day, and come and see us if you're in the Northwest in August, because we'd love to see you. I think.
By the way, I told Debbie to call you, Tom. I said, just call the guy who's in charge. She goes, I'm not calling Tom.
Thank
No
goodness
way
somebody
am I
will do
calling
it.
Tom.
Well, anyone who calls Tom's these days gets forwarded to me. So,
Oh, well, now we know what you're doing all day.
exactly.
Good. Forward. I'm going home. Forward.
Yeah.
Thank you all for joining us. Thank you all for being our clients. And please, as I said, refer people to the podcast. And if you know people that need direct help one-on-one, refer them to your advisor. We'd love to help more people here too. So we're grateful, frankly, for the business that we built here in 16 years here in a couple months. Don and I, and being part of Apella, all these things have worked out very well, very, very well. And we hope you feel the same way. But we thank you for listening to us and following our advice. It means a lot to both of us and our entire staff. I guess I put it that way. So,
Or all 3 of us.
1, 2, 3.
Yeah.
Thank you all.
Thank you.